Welcome back, traders. This is Sheba here with your full market breakdown. And boy, did we have quite the shift of tempo last week, and one that honestly I believe has the potential to provide a ton of tradable setups to the upside in the coming weeks. It's all going to depend on how things consolidate in the coming days. Now, before we cover all the names that are front and center on my watch list and why I believe they should be on your watch list as well, we're going to analyze the market indexes, the major buy signal that was flashed last week, and manage expectations for the coming weeks. We're then going to take a peek at current market sentiment and discuss what it's telling us. And then, as promised, cover all those top stocks to watch, such as AMD, DraftKings, and PLTR. We've had a very interesting week, so let's dig right into it, beginning with the indexes. This is the NASDAQ daily chart, that tech index, ticker QQQ, as of Friday. And you can see we've been in this sluggish downtrend for quite some time now. It officially entered correction territory early last week, which is when price moves 10% or lower off of the previous highs, which in this case occurred in late July. Now, we did discuss a couple weeks back that market corrections are perfectly normal occurrences in any major primary trend, in this case the uptrend, and the current one is no different from the rest. The best way to make sense of this is through historical analysis, looking back at previous bull markets so we can kind of know what to expect going forward. So now we're looking at the weekly chart of the QQQ, and we're going to quickly study this previous bull market, that monster COVID bull market that we all remember so well. So we bottomed in March 2020. We had our first leg up of the uptrend before having that first market correction. So every stock, every index, asset that can be traded will always have corrections as their trend progresses. They occur in trends on all time frames, the 2-minute, 5-minute, hourly, daily, weekly, it doesn't matter. Point is, corrections are necessary and they're a regular occurrence in any trend. And they're simply just a result of natural profit taking and institutional repositioning. So we have our first leg up here, a market correction, which is once again when price falls 10% or more from the previous high. The Qs in this case fell 14%. It's also important to note that all market corrections share one common trait. The overall sentiment is generally very pessimistic. There's going to be a lot of negative headlines that are going to call for, the next bear market, or analysts advising to short the market. Jim Cramer, one of them, more than likely. And then you probably will even have Michael Berry trying to call the top of the market for the 12th time in the last 6 to 12 months. He's going to eventually be right. And when he is, everyone's going to forget about all the times that he was wrong. However, my point is, during market corrections, it becomes very difficult to see both sides of the coin. It's very easy to fall in line with the masses and bet on it being that market top. And it's because of this married bias that so many market participants either get taken to the butcher shop when that market correction does resolve back into the direction of the primary trend, or because of that strong bias, they don't feel confident going long when that consolidation breaks to the upside. And by the time they do feel confident, they're getting in when the move has already mostly played out. And at that point, they're simply exchanging hands with institutions or smart traders that got in earlier like they should have, and basically getting caught in the top. And then this leads to heavy losses on their part, frustration, and just another trader that believes the market is rigged and after them and that it's impossible to make money as a trader. But in reality, they're simply oblivious to how the markets move and the psychological weapons that are employed against them. If you want to become a successful trader, become a contrarian thinker. Incorporate sentiment analysis into your routine. The reality is 95% of retail traders do not make money in the markets. They are wrong the majority of the time. When they are greedy, you should be fearful. When they are fearful, you the contrary. When the headlines are consistently negative, you become increasingly more optimistic. If they are frequently positive, you move with greater caution. Very easy way to incorporate sentiment into your analysis is by using the Fear Greed Index that you can find on CNN.com. I'll link it in the description. The further the needle is to zero, extreme fear, the more likely to find a tradable bottom. The closer to 100, the closer the markets are to finding a temporary bottom. Reason being is because markets bottom and top at market extremes. So remember, market corrections are a normal function that occurs in any market trend and are simply the result of natural profit taking. The indexes enter correction territory once they fall 10% or more off their most recent high, and the overall sentiment throughout a correction tends to be very pessimistic, and you could track this using the Fear Greed Index linked in the description below. So here we have our first leg up, correction, second leg up, correction, third leg up, correction, that then turns into the first leg of the bear market. Trends usually have 3 legs before reversing, and just understanding that concept would have had you on high alert as this base was developing and more confident shorting the breakdown. So here we have our first leg down, correction in the form of a snapback rally. You can correct either through time, which is sideways consolidation, or you can correct through price, which means you have a pullback to a key moving average. We have our second leg down, correction in the form of another snapback rally, and then we have our final third leg down, and at this point we know the likelihood of another leg down is increasingly low because we've already had 3 legs down, making us more confident in taking any upside breakout, which is why we were so aggressive throughout this whole move to the upside earlier in the year. So you may wonder, where does that leave us now? Well, technically this is just the first leg up, and we're in the midst of our first market correction. And if we break above the July high around that 387 level, it would indicate the second leg of the uptrend is now in motion. And we could then expect for there to be another correction, just like the one we are currently in now, and then potentially have a third leg up, which probabilistically is likely to be that final leg. However, in very powerful trends like the bull market that followed the 2008 financial crisis, there was additional legs beyond that third. So you always want to remain open-minded. That bull market saw 5 legs up, and there's also always the potential that you don't have 3 legs up. Sometimes you have just 2 legs up or even 1 leg up. Also note the massive cup with handle currently forming on the QQQ weekly. If we break out of this, it could really generate a powerful move to the upside. And that's really where much of my optimism comes, is looking at this pattern. There's one similar on the gold chart. However, the gold chart is a 10-year long cup with handle. You break out of that, it's going to be powerful. This is the QQQ daily. Let's have a look and discuss the recent price action and kind of what to expect in the coming days, weeks. We have this ABC kind of correction going on here. I've shared a few times in the newsletter over the course of the last few weeks that I believe the big tech names, Apple, Meta, Nvidia, Google, would likely need a breakdown before the market finds a true bottom. We did get that in several of them over the course of the last couple of weeks, that being Nvidia, Meta, Google, and Tesla, which is actually surprisingly a positive thing. It shows capitulation. The only names that were managed to hold up finally gave in. Not all of them, but several of them. And the combination of that and the already brutalized oversold conditions of the rest of the market led us to an explosive move to the upside off of the more dovish sentiment that was received by Powell. A few things to note here. We got a follow-through day on Wednesday, which signals the start of a fresh rally attempt. And these occur when either the S&P or QQQ close up 1.7% or more on volume greater than the previous day, and basically act as an alert there's been a major momentum shift, and that you should be more so focused at that point in time on long opportunities and be extremely cautious if short. They can fail, which would come in the form of a price undercut of the follow-through day's low. However, note there's never been a major upside move or a bull market of any kind that's began without a follow-through day. If you go back to January of 2023, this is the start of the bull market, the first leg up. You could see that we had a follow-through day on January 6th, the day that began the massive rally. And there were several follow-through days along the way. Now, follow-through days, as explained prior, do not always work. There's already been 2 follow-through days throughout this most recent correction that have failed. So never look at them as a reason just to get carelessly long. It's simply a technical characteristic that shows a change of behavior, and an obviously bullish one. Now, although we did already have 2 follow-through days that failed, it is important to note that the more follow-through days that fail consecutively, the more likely the next is to work. Considering 2 have already failed, and the price action as powerful as this week, I'm pretty optimistic this was the start of the next major leg up, but only time will tell. What's most important now is how price consolidates this upcoming week. Do we sell off sharply, or do we hold a nice narrow range as the short-term moving averages catch up to price? We'll have to see. Let's address the fact that we have left not 1, not 2, but 3 gaps unfilled during this move up. That is power, straight institutional accumulation. Couple that with the fact that the index is up 6 days straight, another sign of strength, and a very rare feat. It really highlights the overall technical strength that we saw last week. Now, we very well could fill a gap or two as short-term profit taking ensues in the upcoming week. However, it would be perfectly normal and not of any concern. The major level to watch, which would really turn this rally on its head, would be if we were to lose that follow-through day's low around that 351.50 level. That would not only imply we had a failed rally attempt, but statistically, 90% of the time a follow-through day low is undercut, the indexes find new lows. So obviously, for the bull case, we do not want that. And if we did undercut the follow-through day lows, we would want to align ourselves with the short opportunities instead. You can see we also closed above the now flat 50 moving average, this teal line, which although is a start, it's a step in the right direction. The index needs to have closed at least 1 ADR above the average for it to be considered successfully claimed and in control of the bulls. When I say 1 ADR, I'm simply referring to the average daily range. As you can see at the bottom left of my trading view, this ticker generally moves 1.61% on a daily basis. So we would therefore need to close 1.6% or more above the 50 moving average in order to have successfully claimed it. Then, in order to really add some conviction to the buyers, we would like to see a successful bounce off of that now reclaimed 50-day moving average to confirm it as support. So if we look back here in early August, the bears claimed that 50 moving average. Price closed more than 1.61% below it. However, they were unable to successfully push us lower off of the retest of that moving average. The bulls then stepped in, attempted to reclaim, however they failed. The bears then took one more swing, took us below the 50, and then defended the moving average as we retested it, successfully flipping that 50 moving average to resistance, which is where we stand today. It's a very important moving average that really dictates the intermediate term trend, so the coming weeks will be very telling. If we have a look at this downtrend line, count the amount of rejections that we've had off of it, I see 5 total. It's important to note that with each test of that resistance, it's showing an increasingly more aggressive opposing force. In this case, the bulls increasingly more aggressive, and therefore, with each test, the likelihood of that trend line being violated is greatly increasing. So usually the fourth knock at the door does the trick. However, in this case, the bears have been quite persistent. Now, the likelihood we break out on this attempt, the 6th, is very high. If we add to the fact that this is the 3rd follow-through day, it further increases the odds, simply because, as I mentioned prior, the more consecutive follow-through days that fail, the more likely the next is to work. Couple that with the more trendline touches that occur, the more likely they are to violate. Probabilistically, things are looking pretty favorable for the bulls. Now, we also have the dollar that had a major breakdown on Friday, and the yields holding onto that 50 moving average just barely. So the dollar breaking down is a major positive and shows that money is flowing out of defensive assets and into the more risk-on names. Also, note the major difference between this rally attempt and the prior two that we've had throughout the last 2 months. The dollar was very strong, the yields were very strong. Now they're both breaking down, and considering they move inverse of risk assets, it's a major positive. So the whole dynamic is quite different this time around. We are in major oversold conditions, sentiment very pessimistic, equities that generally move inverse the risk assets, the indexes, are breaking down, and the overall power that was seen in this rally attempt quite uncomparable to much of anything we've seen this year. So quite optimistic. However, things can untangle quite quickly. So we do want to manage our expectations going into next week, which we're about to do right now. And the way we will do this is by simply asking ourselves 2 different questions. The first, what price action could be expected this week that would be considered perfectly healthy and normal and likely to lead to future bullish outcomes? And the second, at what point would this chart no longer look bullish? And by answering these questions, we manage our expectations and can plan around them. This is going to lead us to be more prepared and decisive traders, which is absolutely imperative. So let's begin with the bullish scenario. How would we like for price to act this upcoming week? And what levels should be closely watched? There's a couple things to note. One is the index is up 6 days in a row. Assets generally move up 3 to 5 days in one direction before consolidating or pulling back. This is just caused by short-term profit taking. So considering we've had 6 days up, we are clearly in the extremes. So we know we are overextended and due for a pullback. So this should be of no surprise this week when we get that and would be considered perfectly healthy. We are just below the downtrend line and sitting above the 50 moving average, which as discussed earlier, we are in a neutral position as of right now. And when an asset approaches a major level while short-term extended, the odds of a breakout working are extremely low. So that major level in this case being our downtrend line and that 50 moving average. With that said, failed moves lead to fast moves in the opposite direction. So we should certainly not be opening fresh longs if somehow we've managed to move higher tomorrow, because the probabilities are very unfavorable. What we want to see is price move sideways or pull back for 2 to 3 days minimum. A key word there being minimum. A longer consolidation would be perfectly fine, providing we hold these short-term moving averages, the 10 and 20 EMAs, because that first pullback is basically shaking out all those weak hands, which is really what we want. Just going to provide a more clean move to the upside if we do resolve back into the direction of the initial move up. We also want to pay attention to the volume throughout the pullback. If it were to exceed that of the volume seen during the move up, that would be a major red flag. In terms of price, we want to see it pull back in a more calm fashion, not aggressively like we saw back in September. We need the bulls to really prove they have a firm grip and are not playing any games this time around. So we want price to move sideways on volume less than the move up, hold above that 10 and 20 EMA, and then after a minimum of 2 to 3 days consolidation, we could look to attempt to breach that downtrend line. And if we were to break out above that downtrend line, the volume should be explosive, as that is a major level. It should look similar to the volume that we saw during the pullback in March. You can see we have huge volume through the pivot. It needs to be at least above the average range. And this is just showing conviction behind the move. And the price should then hold above that breakout candle's low if the bulls are truly in charge. So if you don't use moving averages, key support levels to watch are going to be 357.5, and the rally kill switch would be our follow through day low of 351.50. Now, what would be a couple scenarios that would raise concern? The first would be if price were to pull back very aggressively. So a powerful move back down. And if that occurs on heavy volume, that would make the situation even worse. It simply tells us the bulls are getting hit hard with supply and are potentially getting overwhelmed. The second scenario would be we move sideways or even have a shallow pullback that forms some kind of significant support level that it then breaches on heavy volume, as we saw during the last two rally attempts in September and October. And if we were to break through that significant support level, that's generally going to happen on or around the same day the 10 and 20 EMAs are lost, further increasing the odds of bearish outcomes. So the bearish scenarios would really just come in the form of a heavy volume pullback through the 10 and 20 EMAs, meaning we lose them, or a sideways consolidation that eventually breaks down on heavy volume. Now, just remember, so long as price holds the follow-through day low of 351.50, the rally attempt is still technically alive. However, if we lose that level, you really want to be aligning yourself with the short side of the market, looking for the weakest names to get involved with, because the odds that we move higher are not promising at all at that point in time. I'll quickly cover the S&P 500, SPY, and some levels to watch. However, I primarily focus on the QQQ because it's the leading index during this bull market, therefore has much more significance than the other two. If you are trading energy names, healthcare, consumer staple stocks, their movements can be more in line with the S&P 500. So it's important we have a look at it and establish key levels to watch. If you're unfamiliar with the stocks sector that you're currently looking at, just go to stockcharts.com, type in the symbol, scroll down to the bottom, press symbol summary, and you're going to see the sector at the bottom of the page. So S&P 500, very similar chart to the QQQ. We're looking for the same thing, sideways consolidation or a pullback on volume less than that of the advance. Major levels to hold, 426.40, and the follow through day low of 418.50. If we break below that, look for short opportunities, but until then, we want to align ourselves with the long side. Major resistance would be the 438 level. That is the most recent high of the downtrend and where the downtrend line currently resides. We want explosive volume through that level at the time that we attempt to break, if we do. Here are the small caps, your IWM. This is the weekly chart. Shared this a few weeks back. You can see resistance turns to support. Also note that this move to the downside was with very little pause. So in other words, it was very extended on both a short and intermediate term basis. And if falling into a major support with those under such circumstances, the likelihood of a bounce is very high. 11 weeks down out of 13 is pretty insane, certainly overextended. And the response from the bulls was a huge bullish engulfing candlestick on monstrous volume that hasn't really been seen in over 5 months, dating back to June. So if the bounce were to have been on light volume, it would have likely just have been a short squeeze that likely would have faded over the coming weeks. However, considering how heavy the volume was and the strength of that candlestick, very big bullish engulfing candlestick, there's undoubtedly institutional accumulation in there, some real buying that is generally seen during the early stages of a trend's development. So all I have to say is if you're short, you have to be very careful here. The daily chart, let's first note we're 5 days up, so short-term extended into major resistance. So we want to see a healthy consolidation for a couple of days prior to a breakout attempt in effort of reclaiming that 50 moving average and the previous lower high. Also note the volume here, that's big buying. Major support level to watch, that 167 level, major resistance 177.2, and then the 200 moving average, which currently sits at the 181 level. That will change with time. Also, this death cross is insignificant. Whenever an asset of any type is in a range, you're going to get several false signals from moving averages. Here we have a golden cross, led to nothing, death cross, led to nothing, golden cross, led to nothing, and once again, death cross with a to be determined outcome. However, considering the previous failed crosses, this one carries very little weight considering that stock is range bound. Alrighty, so we've established all the indexes are currently moving in the same direction, which is what leads to the most powerful moves in the market. And that's simply because if the majority of stocks are trending in the same direction, the dominant force of the market is parallel across the sectors. And when you get that, that's where the most fluid moves occur. Here, May through July, we had a massive move up in IWM. May to July, a massive move up in SPY. May to July, massive move up in the Qs. When all the indexes move together, whether it be up or down, the strongest, most powerful moves are to follow. And as traders, where we want to be most aggressive. So this week, we're looking for price to consolidate. The bulls need to prove themselves to us. And if they do, in the form of a higher high, we will target these strongest names. So with that said, let's get to the fun part here, my watch list and your current market leading names and how we can play them in the coming days or weeks. So let's start here with AMD. I'm going to go ahead and add our long-term moving averages. And you can see that we had this really powerful move to the upside on heavy volume. The price is now above all of the moving averages, both our short, intermediate, and long-term. We broke through this downtrend line, which is obviously a step in the right direction. And as of right now, we're just above this base resistance level. We closed above it. And that also just happens to be the former lower high of this downtrend. Now, with that said, the likelihood that we forfeit this level and pull back below that resistance as price digests the recent gains and we kind of allow these short-term moving averages, the orange and green line, your 10 and 20, to catch up is fairly high and wouldn't be of any concern. We're looking for some sort of sideways consolidation or pullback on light volume before continuing higher. These transparent candlesticks are how I see it potentially playing out if we are to get bullish outcomes. What you want to do is as price is pulling back here, you want to kind of draw a trend line over the highs of that pullback. And if price breaks across or above these highs, go long on the break of that trend line if it's accompanied by heavy volume, with a stop loss being at the low of day. All stocks that are going to be covered today are not actionable and will not be actionable for several days. We're simply preparing and managing expectations. Now, the one major negative for AMD that none of the other stocks on our list have are simply the overhead that we have to chew through. And this overhead is a negative simply because it means we have a lot of sellers that are trapped up here and are looking to get out. So we're likely to, if we continue to move up in this move, if we continue to have an upside move, have more of a grind to the upside versus just having a clear, powerful move in the direction of the current trend, just because we have to cut through all this supply. So that's a slight negative. However, it still looks like a great looking chart. Next, we have ANET. Now, note every stock going forward is going to share the same bullish characteristics as AMD, plus more, such as the fact that ANET is currently at all-time highs and also has an unfilled gap, which is very bullish. And the fact that we have no overhead supply, right, is great because we have no sellers or supply that we need to worry about overhead. Also note this huge volume on the move up. That's the kind of power through the pivot that you want to see. We're looking for some consolidation in the coming days and then a break higher. Once again, just draw your trend line above the consolidation, or if it moves sideways, just give yourself a little, box like that to play around with. Basically, what we're looking for in all of these names is some sort of bull flag and then break higher. Next up, we have pins breaking out of this huge 2-year consolidation on very heavy volume. The longer the base, the stronger the move that follows. If we zoom out, you'll see that we have all of this overhead over here, which at first glance is quite concerning. However, it actually has no significance or very little significance in this case. And the reason being is any overhead that is older than 1.5 years carries little weight because these trapped sellers have more than likely already been flushed out as that stock continued to plummet. They just wanted to get out. They didn't want to deal with the losses that they occurred throughout this giant move down. They've become, disgusted with the name and they just want to forget about it, so they get out. And it's really as simple as that. So pins really has very little overhead to deal with. It doesn't mean that there aren't some people that bag held throughout this entire move down, but it's not nearly as significant as if, say, this overhead was right over here. It was within the last 6 months. Then you'd have a lot more trouble moving higher. But the fact that it was been over 1.5 years, very positive for the chart and likely to have powerful moves to the upside if this trend does continue. So we could see some consolidation sideways, or maybe we pull back, retest this former resistance level. We'll have to see, but needless to say, it definitely needs to pipe it down and relax for the next couple of days before breaking higher. Next up, we have Palantir. So note the unfilled gap. We didn't just gap up and then start consolidating right away. We actually gapped up and had follow through. We broke our downtrend line. And now all we're really looking for is to consolidate for maybe 3, 4, 5 days. If longer, no worries. Let these moving averages catch up. Potentially flip this resistance area to support and then break higher. Very little overhead to be concerned with. Once again, this overhead no longer really in the equation because of how old it is. So with that said, we're just looking for that consolidation and then break higher. Same situation with basically every stock, right? So next up, we're going to have Shop. Shop, a little more overhead to deal with. We also have this unfilled gap that's going to act as a major resistance, at least briefly. We're still within the downtrend, and we have quite a bit of overhead to chew, although nothing crazy. We did have that huge gap up, currently left unfilled above all the moving averages. And we're just looking for some kind of consolidation below this downtrend line and then a break higher. And then here we have some resistance levels that we can keep an eye on. Likely, consolidate at these levels, then break higher, consolidate, break higher. We'll have to see. However, Shop does look great. I love that volume that stepped in. We also have Dash. So Dash looking for the same exact thing. It's a little more extended than most of the other names. And we're also at a key resistance level. So I'd like to see a more extended consolidation here. Maybe 4 or 5 days. Even longer would be better. Let those short-term moving averages catch up. We're also a little bit extended, I think, from the 50-day moving average. Let's see. Getting there. We're getting there. So I would want to have a little bit lengthier of a consolidation here. Uber also reports this week, and that's going to have an impact on Dash as well. So if Uber's report is negative, it's going to definitely weigh down Dash, likely pull it into a more lengthier consolidation. Perhaps we get 2-3 weeks of consolidation. However, if Uber's report is positive, it will probably further ignite this move and really cause it to become extended. And in that case, we would need to wait for it to really consolidate over a period of 2 to 3 weeks before it really provides a prime risk reward long setup. DraftKings, love this one. Definitely need to see some consolidation, just like the rest. I know I'm kind of stuck on repeat, but just note all of the same characteristics are shared on this list. Powerful moves up on very heavy volume. This is actually breaking out of a shaper pattern. So just like the indexes have their corrections along the way, stocks do as well. So we break out of our stage 1 base. We then have a correction, and we're breaking out of what's referred to as a 3 trendline touch breakout. So this is a shaper pattern breakout. Basically, right when we get above this high, we're starting our next leg up. First leg up, second leg up. So the fact that this is basically already at its second, the fact that this is basically already moving into that second leg up ahead of the indexes is telling you that it's a leading stock. So we really want to focus on these leading stocks. Dash, the same exact situation. In fact, it's just marginally better than DraftKings. It's leading. It's starting that next leg up ahead of the indexes. Shop, not so much, but fairly close. Palantir, very close as well. Almost already on that second leg up. Let's take a look at pins. Pins, only the first one, so a lagger. However, look at that volume. Monstrous. Out of a base. Can't ignore that. ANET, once again, already had its first leg up. Now we're starting the second leg up. This is actually leading every name we've looked at. AMD, quite a bit suppressed versus the rest. Definitely the worst on this list, however, certainly tradable. And then here we have Fast. We have our first leg up. It's already in its second leg up. So if we take a look at the daily chart on Fast, you can see we had a huge gap up. We partially filled it, that mainly being due to the immense pressure it was receiving from the broader market sell-off. And now we've pushed right back up to the former high, where we'd like to see consolidate for a couple of days before breaking higher. All of these names are actionable with both trading instruments, that being shares and options. However, ANET, you might have a little more difficulty there. Really anything that has less than 2 million volume on an average basis might be a little more difficult with options. So I would definitely avoid options on ANET. However, all of these guys are definitely actionable with options. So let's be patient. Wait for these guys to set up. We're looking for 3 to 5 day consolidations minimum on every name here. And once we do get a break higher, we look to get involved. So stay patient. If you have any questions, feel free to reach out. Thanks.